Joining us right now to weigh in is Kadina Group President Gary B. Smith. Gary, good to see you, sir. Thanks so much for weighing in here. Now, you look at this market through a technical lens, technical analyst. Tell us what you see from these moves and the tech from a technician's eyes.
Well, Maria, I was trying to put this in perspective. What was this like? Was this 1929? Was this the crash, if you will, of 2008? Was it the tech bubble? And I think mostly it feels like the crash, that Black Monday of 1987. We have gone up since the lows in 2009 about 220% or so. We had the same run up to October of 87, about 270%. What was the cause in 1987? You heard almost the same exact things as you did now. Well, maybe it was derivatives. Maybe it was this algorithmic trading. Maybe it was overvaluation, but there was no collapse of any asset bubble like we saw in, the internet crash and the housing bubble. And in fact, shortly after that Black Monday, Black Friday in 1987, the market came down severely, more severely than it has now. And then it started rising up again pretty much to the late 90s. That's what it feels like to me. It feels like we just got rid of some of the overvaluation. We don't really know what the cause is. We can pretty much assume it's not an asset class. That's why I'm bullish.
Gary, James Freeman here with the Journal. Looking at history as you have, obviously people were concerned about that yield on the 10-year government bond going to 2.8% roughly, thinking maybe it goes to 3, even 4. But you probably remember a lot of years in the 80s and the 90s particularly that were good for stocks where interest rates were quite a bit higher than they are now.
You make an excellent point. I look back in the early 60s, James. I look back in the 80s. And back then we had actually inflation just a little bit higher than we have now, like 3.5% inflation. People forget inflation right now is only 2%. Yet we had a Fed funds rate that was nearly triple what it is now, almost 4.5%. Yet we had higher GDP, almost triple the GDP, and we had lower unemployment. So people are worried, and maybe rightly so, about inflation, but we have a completely different environment right now. We didn't have the internet back then. If Walmart wants to raise prices, then you just go right to Amazon. If Amazon wants to raise prices, you go down the street to your local retailer. It's very difficult right now for anyone to raise prices because we have a completely different environment than we did 5, 10, certainly 30, 40 years ago.
Yeah, but isn't there an unknown when you look at policy? I mean, the trade situation, for example. We just put tariffs on washing machines and solar panels, and we may very well see tariffs coming on aluminum and steel. How does that change the situation?
Well, you're absolutely right, Maria. It's always, we don't know what we don't know.
Exactly.
There could be something out there. I'm not saying I have a crystal ball and I can foresee everything in the future.
Yeah.
Yes, well, we don't know the ramifications. We thought by now, a lot of people thought North Korea would have had a nuclear missile headed straight to Japan. That hasn't happened. It seems to have been mitigated. That was the worry just a few months ago. Could there be more worries about a trade war? Yes,
yeah.
absolutely.
I mean, I feel like things accelerated last Friday on the downside when that Trudeau headline came out, when Trudeau said, I'm willing to walk away from NAFTA, and things really fell out of bed from there. That was last Friday. But look, we're going to be nervous until we actually see evidence that we're not seeing inflation, right? So the CPI for January comes out Wednesday, and then you've got a number of things in terms of inflation indicators that are coming out. G20 meeting caps it all off in the middle of May, but you got the FOMC meeting February 21st. FOMC meeting. Yeah. Is that going to be one of the 3 hikes that we're expecting from the Fed, Dagan, on the 21st?
Possibly,
yeah.
And it depends. You saw that wage number, 2.9% wage growth in the most recent month. Gary B., just really quickly, so you had a 22% sell-off on Black Monday back in 1987. Right. I'll point out it was 2 months after Alan Greenspan took the job as the Federal Reserve chief. We've got a new Fed chief at the wheel at this point. Do you think we get to that kind of downdraft? We're down 10% on all your major market gauges. Do we get to 20?
I don't think so. It was either yesterday or the day we had the first 1,000-point sell-off. We had the most negative advances to the rises since 1947. Dagan. So that means people were selling indiscriminately. It didn't matter if it was Amazon or the doggiest of dog stocks. That means pessimism across the board, and I've seen sentiment indicators across the world is almost the exact reverse of what it was just a few weeks ago. It's almost approaching now all-time highs. That tells me we're probably closer to a bottom than we are to a top. Who knows? Yeah, I mean, there could be, but I'd rather be a buyer right now than a seller.
So the investors, we were just talking about the $100 billion that went into stock funds in January, remember, right? So this week, investors pulled $30 billion from equity funds in the last
exactly
week.
To my point, yeah.
Yeah, so very quickly, if you're bullish, what do you buy right now? What do you buy in a market that you know is probably going to open lower?
I always go back to the stocks that I think have a little moat around them. The number one is Amazon. Very difficult to beat them. Walmart is trying,
Amazon.
but
what is that trading at 100 times earnings? Is that at 100 times earnings yet?
When you have a company, 100, 200, it doesn't matter because they can fight off. No, I'm not. I'm not saying. Well, as a technical analysis, I don't pay much attention to that.
Okay.
But when you have a company now challenging UPS, FedEx, Kroger, Safeway out there, they have their hands in everything.
All right.
Love the company, love the stock.
All right, we'll leave it there. Gary B. Smith, always a pleasure, sir. Thank you.
Thank you, Maria.
Stay with us.